In the summer of 2007, the hedge fund industry was at the peak of its power. Elite active managers had amassed vast fortunes and near mythical status for their ability to pick winning stocks. But that same year, the Oracle of Omaha proposed a wager. He bet that over a 10-year timeline, the most highly compensated financial wizards on Earth would be beaten by a simple, unmanaged index fund. Warren Buffett issued a $1 million challenge to the industry. Ted Seides, co-founder of the investment firm Protégé Partners, accepted. Seides selected 5 elite funds of funds, baskets of the best hedge funds available, and pitted them against a basic Vanguard S&P 500 index fund. To understand Buffett's confidence, you have to understand the zero-sum axiom of trading. For every buyer in the stock market, there must be a seller. If one active trader beats the market average by 1%, another active trader must underperform it by exactly 1%. Before fees, the aggregate gross return of all active trading simply equals the market average. This graph plots how that zero-sum equation breaks down. The active investment industry charges roughly $140 billion a year in fees. Subtracting those management fees, bonuses, and transaction costs makes active investing a negative-sum game for the client. When the 10-year wager concluded, the math proved inescapable. The Vanguard Index Fund generated a return of 125.8%. Protégé's basket of elite hedge funds delivered just 36.3%. This exposes the central paradox of passive investing. In financial markets, embracing mediocrity, choosing to own the exact mathematical average of the market, virtually guarantees outperformance over the majority of highly compensated professionals. The modern index fund relies on mapping the entire market, but in the mid-20th century, that map did not exist. Despite the daily trochium of the Dow Jones, no one actually knew the historical, long-term returns of the total United States stock market. That changed when the Center for Research in Security Prices was established at the University of Chicago. Funded by Merrill Lynch, the center undertook an exhaustive effort to map the daily price and dividend data for every stock on the New York Stock Exchange from 1926 to 1960. The resulting dataset was a bombshell for the financial establishment. The numbers revealed that simply buying and holding all the stocks on the exchange yielded a consistent 9. This massive dataset provided the empirical backbone for 2 emerging academic models: the random walk hypothesis, which argued that stock prices move unpredictably, and the efficient market hypothesis, which posited that prices reflect all known information, making it virtually impossible to consistently beat the market. Translating these academic theories into a functional financial product required immense computing power. In the late 1960s, a management sciences unit at Wells Fargo acted as a financial Manhattan project. They utilized expensive, state-of-the-art IBM mainframes to run the algorithms needed to apply this academic theory to real-world capital. The index fund did not emerge as a Wall Street marketing gimmick. It was engineered as a physical solution to a mathematical reality, a tool built to process the empirical data, proving that active manager supremacy was a myth. The first physical application of this theory was built in 1971 for the Samsonite Corporation's $6 million pension fund. The strategy was to hold an equal dollar amount of all 1,500 stocks on the New York Stock Exchange. This diagram illustrates why equal weighting was a logistical disaster. To keep the dollar amounts equal as stock prices fluctuate daily, the fund requires constant rebalancing. You are forced into the constant selling of winners and the buying of losers, bleeding capital through transaction costs. The engineers quickly pivoted to a market capitalization weighting structure, mirroring the newly prominent S&P 500. Because companies are weighted by their total market value, the structure naturally self-adjusts. As a company's value grows, it occupies a larger percentage of the portfolio, requiring 0 external transactions to maintain the balance. While Wells Fargo built index funds for corporate pensions, Jack Bogle brought the math to the public. After being ousted from his previous firm, Bogle founded Vanguard and launched the first retail index mutual fund in 1976. Wall Street mocked it as Bogle's folly. The initial public offering raised just $11 million. That wasn't enough capital to physically purchase all 500 stocks in the S&P index, forcing them to run a truncated version of the portfolio. But Bogle implemented a corporate governance structure that ensured Vanguard's early survival. He structured Vanguard as a mutually owned company that operated at cost. All profits were returned to the funds themselves, relentlessly driving down fee drag for investors. The final structural leap occurred in 1993, when Nate Most invented the Exchange-Traded Fund, or ETF. This innovation wrapped the entire index into a single share, allowing baskets of hundreds of stocks to be traded instantly on an exchange, just like a single equity. By solving the mechanical friction of portfolio rebalancing and eliminating corporate fee drag, Vanguard and the ETF wrapper removed the final barriers between ordinary investors and the market's total return. This chart compares global asset pools to illustrate the scale of the passive ecosystem. There is now over $19.3 trillion in public index funds, with global passive assets approaching $30 trillion. That is larger than the hedge fund and private capital industries combined. To ground those numbers in physical reality, the largest gold ETFs now hold nearly 1,000 tons of physical gold bars in their vaults. That equates to roughly a quarter of all the reserves held in Fort Knox, owned by a single financial product. This accumulation of capital naturally invites a structural critique from the active management industry. If tens of trillions of dollars are blindly buying the entire market, regardless of underlying corporate performance, does this block of capital destroy price discovery and market efficiency? This diagram represents the market as a poker game, using an analogy developed by Michael Malbusin to address that fear. In any high-stakes game, you have elite players and you have mediocre players. As passive investing grows, it doesn't remove the elite card players. It squeezes the lazy, high-fee active managers, the weak players, out of the market, replacing them with passive index capital. With the easy money gone, the surviving active managers are strictly the elite. They are forced to rely on increasingly sophisticated algorithms, faster computing, and alternative data to find an edge against each other, raising the competitive bar. The math is clear. Index funds do not kill market efficiency. They apply a relentless evolutionary pressure that purges mediocrity from the financial system. However, the dominance of indexing does present legitimate systemic risks. The first is how Wall Street has weaponized the ETF wrapper to sell complex, toxic synthetic vehicles to the general public. Products like quintuple leveraged funds and VIX-linked exchange-traded notes serve almost zero investment purpose. They are dangerous trading mechanisms that have lost retail investors staggering amounts of capital. A deeper structural risk lies in the shift of global power toward index providers, such as Standard & Poor's and MSCI. By defining the criteria for which companies get included in a benchmark, these private firms now dictate the flow of trillions of dollars, granting them quasi-regulatory power over the global economy. But the most serious warning comes from Harvard law professor John Coates, who identified a looming corporate governance crisis he calls the problem of 12. The passive industry relies on economies of scale, creating a winner-take-all dynamic. Today, nearly 80 cents of every newly invested dollar flows to just 3 firms: Vanguard, State Street, and BlackRock. This network graph maps the resulting concentration of corporate voting power. This concentration mathematically dictates that in the near future, a tiny group of individuals, roughly 12 executives across these asset managers, will control the majority voting rights of virtually every major publicly traded corporation. This forces index funds into the paradox of active ownership. Through ESG mandates and proxy voting, these massive passive owners are now using this voting power to impose environmental and public policy standards across the entire corporate ecosystem. The index fund was designed to democratize finance and strip power away from high-fee gatekeepers. Paradoxically, its success has centralized corporate control into the hands of an unaccountable oligopoly. Despite these structural risks, active management remains vital to the system. The market requires active participants trading on fundamental analysis to provide the liquidity and price discovery required for the passive engine to function. But for the individual investor, the Pareto principle governs equity markets. Historically, just 2 to 3% of stocks account for almost all long-term market gains. If you fail to pick those specific companies, you will underperform. This makes active stock picking a statistical trap for the majority of participants. The technology continues to evolve. The next frontier is direct and custom indexing, where software will allow retail investors to unbundle the ETF entirely, directly owning and filtering the underlying components of an index themselves. Jack Bogle famously stated that in most aspects of life, you get what you pay for, but in investing, you get what you don't pay for. The index fund stands as a hard-coded solution to the problem of human error. It remains a permanent testament to the power of respecting mathematical probability and trusting the arithmetic of compound costs.